Hey everyone, it's Iggy here from the Investing Iguana. Let's walk through Malaysia's 2026 budget and why this matters for you, especially if you're a Singaporean investor watching the big stories in our region. Here's the challenge. No matter what market you're in, there's always this tension. You want solid growth, but you don't want it to come at the cost of letting things run wild with debt and inflation. You see news about Malaysia rolling out its biggest ever budget, and you're asking, is this good for investors? Or is it trouble waiting to happen? Well, in this video, I want to break down the whole budget in a way that's clear, practical, and down to earth. If you're new here, I've spent years deep diving into Singapore and regional investing, so you don't have to stress about the numbers or policy changes that seem too technical. We'll walk through the major sections just like my recent Substack article, why the budget matters for Singapore, what's inside, the main growth drivers and risks, the regional opportunities, especially Johor and the SEZ, and my personal take on what this all means for you. So, first up, why does Malaysia's budget 2026 matter for Singaporean investors? It's not just about what happens next door. It's about how our markets and economies are hooked together. Think about it. The Johor Singapore Special Economic Zone, SEZ, cross-border supply chains, and even how funds move between countries. Malaysia's projecting growth of 4 to 4.5% next year, and that signals steady demand for electronics, property, and commodities, all things we care about. But at the same time, Malaysia wants to stay disciplined, not overspending and not sparking runaway inflation. That brings us to the allocation. Imagine this table laid out. Armed $338.2 billion for government operating costs, $181 billion for development, and a $50.8 billion channeled into investment partnerships. What does this mean? Most of the spending keeps the wheels turning. Schools, infrastructure, services, while a focused chunk aims to drive new growth through public-private partnerships. It's like Malaysia is making sure the cake is solid before layering on the icing. Let's talk about the guts of the budget, the growth drivers, and the big risks. First, electronics and exports. Malaysia's riding high in the global electronics market, especially semiconductors, about 40% of the country's exports. But here's the kicker. U.S. tariff risks, especially for Malaysia's biggest export sector, loom large. The government is cautious, knowing that these policies could hit supply chains hard. Here's how I look at it. For Singaporeans, this means you want to be picky about tech plays. Sure, there's upside in things like data center REITs and logistics players with semiconductor tenants, but don't bet the farm. Personally, I'd keep this at 5 to 8% of your portfolio. It's kind of like seasoning your soup. Too much, and you ruin the taste. Watch for tariff news and use market dips as entry points, rather than piling in at the top. Now, infrastructure and PPP, public-private partnership opportunities, are next. Malaysia's development spend slips a bit from last year, but what's important is the private sector stepping up. There's $30 billion from government-linked investment companies, $10 billion from PPPs, and more from statutory bodies. If you're used to thinking of infrastructure as boring, think again. These funds are fueling highways, ports, and digital infrastructure that underpin long-term returns. So let's pause for a second. I like infrastructure REITs and bonds with explicit PPP support. They offer steady cash flow and aren't as easily rattled by budget cuts. If you're allocating in Malaysia, why not put 10 to 15% into vehicles with Johor and Selangor exposure? It's a nice steady anchor in a mixed portfolio. Here's something a bit more headline-worthy: social handouts versus fiscal discipline. Under the SARA scheme, 22 million Malaysians get a one-off R100 handout. The government is focused on helping lower-income households and supporting businesses. Yet even with all this, the budget deficit narrows from 3.8 to 3.5% of GDP. That, to me, is smart budgeting. It keeps bond yields attractive, holds inflation at bay, and signals credibility to international investors. Honestly, I used to get tripped up by the idea of deficits. But now, I ladder my bond maturities across 3, 5, and 7 years, and ride the curve as the government continues its drive for fiscal discipline. Why stress about market timing when you can set it and forget it with solid bonds? Let's move to regional focus: Sabah, Sarawak, and the Johor Singapore SEZ. Sabah and Sarawak get major allocation bumps, RM 6.9 billion and RM 6 billion this year, more than double. from 2022. The SCZ, meanwhile, gets huge digital and green grants. Think R2 billion for a sovereign AI cloud and RM53 million for blockchain, AI, and quantum tech. If you visualize the table, you'll see just how dramatic these boosts are. East Malaysia is now a development hotspot. What does this mean? If you're looking for long cycle plays, early movers in utilities, logistics, or infrastructure funds in Sabah, Sarawak could see major growth. The SCZ is a magnet for tech investment, with data center REITs in Johor becoming Southeast Asia's next big thing. These investments aren't flashy, but they're foundational. Now, the fiscal framework. Malaysia's not going wild on debt. The new Fiscal Responsibility Act and the introduction of a carbon tax, 45 to 150 per ton, set clear guardrails. Excise duties on cigarettes and alcohol go up, and the carbon tax launches in November. It's about shifting from tax and spend to tax for purpose. So how do I play this? I favor companies with strong ESG plans, solid decarbonization strategies, and diversified revenue streams. Carbon tax will squeeze traditional steel and energy, but it also funds green innovation. Avoid pure play polluters unless you're getting a bargain. My take. This will create winners in renewables and push consolidation. So keep an eye on sector leaders making big ESG moves. By the way, if you want all the reference tables, checklists, and the written version, everything's on Substack. The link's just below. Let me zoom in on some actionable recommendations. For buy, I'm looking at Johor data center REITs anchored by long-term cloud and AI tenants. Imagine the stability. Also, infrastructure funds that tap into the boom in Sabah and Sarawak expect mid-single-digit returns, plus inflation protection. For hold, commodity producers with clear decarbonization plans and large-cap tech exporters, unless tariffs spike. These are worth sticking with. For sell avoid, I keep away from leveraged small-cap industrials facing tighter excise rules. They just don't have the buffer. Now, practical steps for your portfolio. First, rebalance your ETFs with a 5 to 10% tilt toward Malaysian mid-caps exposed to the SEZ. Quarterly check-ins keep risk tight, and you can catch any mispricing. Next, ladder those bonds and lock in yields. Favor AA and up for rating. And finally, watch Sabah political volatility, especially around the December state election. Sometimes a sell-off opens a nice entry point in regional equities. Here's my honest take for Singaporean investors. Malaysia's budget is steady, strategic, and designed to balance social needs with growth. Concentrate your allocations in areas with government backing, ESG readiness, and regional tie-ups. Don't react to election noise with panic. Instead, see volatility as a way to snag well-priced assets if the fundamentals stay strong. All right, before we wrap up, if you're still with me, I hope this walkthrough helped de-jargon the whole budget story and gave you concrete ideas to act on. So if you're planning your next move, remember, steady growth often beats chasing the next headline. If you want to check out the full written version with all the tables and breakdowns, hit the Substack link below. What are you looking at this month? Is there a sector or company catching your eye? Let me know in the comments. I love seeing what's on your radar. And if you want early access, join our members club. It's about connecting, sharing, and getting those direct insights before anyone else. Link is below, and I'd love to see you there. If you found this valuable, check out my last video on the top Singapore REITs for 2025. It's all about finding regional opportunities with confidence. All right, that's it for today. Stay curious, stay informed, and as always, keep investing Iguana style. See you in the next one.